Hey everyone, my name's Andy. I'm from Finding Value Finance. I'll be your host today. Lucky enough, we've got Doomberg with us. I'd like to get some insights from him with some questions, mainly based in energy and maybe the markets a little bit. So thanks for coming on, Doomberg. Really appreciate it for the time.
Yeah, Andy, great to be back. I enjoyed our last appearance and looking forward to another fantastic discussion. Thanks for having me.
All right, so jumping right into the energy markets. What are you seeing in the energy markets at the moment? What's your views around it, kind of in general, from a big macro picture view?
Yeah, it depends on which commodity and which geography that you're talking about, of course. As you know, the energy markets are highly complex and are best studied across those lenses, amongst others. If you sort of look at oil, I'd say oil is physically tight and prices are a bit elevated. Coal and natural gas are long off their highs that we saw the last time you and I chatted, in the midst of the energy crisis. I think when energy is tight, the prices of oil, natural gas, and coal tend to correlate to their inherent energy content and trade accordingly. And when energy supplies are a bit more balanced or in excess, you tend to see oil trade at a significant premium to coal. And then natural gas has its own very, very tight regional dynamics. But if we look across the world today, oil, hovering around $90 a barrel, WTI, low 90s for Brent, which I think is a very comfortable price for all players involved. The OPEC plus Saudi, Russia alliance needs elevated prices, and Biden and the G7 countries in the West need prices that aren't out of control. And so in that 85 to 92, 93 type range, I think that's very comfortable for all parties. Biden can head into the 2024 election with oil prices where they are without it being sort of a scandal or the top of every 24-hour news cycle. Natural gas, of course, as a byproduct of oil drilling in the U.S. and having excess supply and difficulty shipping it around the world is an entirely different beast. But we would characterize the natural gas market in Europe, at least, as being in peak complacency. The winter was warm last year, thankfully, and the region was able to skate by with some significant costs, but certainly didn't subject themselves to the worst case scenario risks that were seemingly on the table last fall. We'll see how it goes this winter. And then coal is reacting to those other markets. And when oil and gas were so short last year, coal spiked. And in fact, for the first time that we can find in the data, coal sold for a higher price than oil on an energy content basis, which was a pretty amazing artifact in the market. And that has since, of course, regressed back to historical norms, which tells us that oil is probably artificially tight, and the other key sort of fossil fuel inputs into our economies are relatively well supplied.
What's your opinions on American production of oil, in particular, like shale oil? I know that OPEC has cut back on production. Like you said, they're kind of restricting some of that. Do you think there's going to be any problems with shale oil out in the future?
So we've seen those analyses, and they are seductive in the sense that the decline rate of the newly drilled wells in the shale patch are obviously substantially accelerated vis-a-vis historical sort of typical oil drilling. Having said that, the numbers from the DOE seem to indicate that we are very slowly climbing back up the hill to recapture the record oil production numbers that we were experiencing pre-COVID. There, on the flip side, there is the rig count and so on that seem to be declining, which would indicate perhaps some pressure on supply. But then counter to that, of course, there's the capital efficiency with which these companies are ever improving their technology base that allows them to get more oil out of the ground per incremental drill or incremental dollar of capital. And so if you look at the DOE data, which many people suspect is not quite fully reflective of what's going on in the field, we're almost back to 13 million barrels a day of, quote, oil production in the U.S. But we do probably feel that that's a bit of a smoothing out of an undercounting of U.S. production earlier this year, because our channel checks don't indicate like a sudden spike in oil production that the data would indicate. But beyond that, of course, as you know, and as we've written about recently in a piece called Molecular Tourism, not all oil is created equal. The real driver of the price of gasoline and diesel and jet fuel and asphalt are, in fact, the refinery capacity and the capability to receive those specific grades of oil. And it's far more nuanced than just the headline numbers would have you believe.
And in terms of natural gas, specifically over in Europe, we know we skated by last year. It was a warm winter. Do you think they're better off positioned this winter than they were the year before? Or do you think there's still a lot of fragility in their system and in their natural gas flows?
If I were to take a step back, I would say there's certainly peak complacency. I do believe, as we have warned, leaders in Europe have confused good fortune with sound strategy. There's no question that that is occurring today. Having said that, it can't be that they aren't, having touched the stove last year but not been significantly burned, that they aren't setting about the task of infusing some redundancy into their energy supplies ahead of the winter. Energy prices are far, far, far below where they were same time last year, which means the economic penalty of doing so is certainly diminished, although compared to international competition, the price of natural gas in Europe is still, amongst the highest that anybody's paying around the world. All comes down to the weather, and there are two schools of thought. One school of thought, which we have sort of hypothesized might be the base case, is that we just came out of a 3-year El Nino weather pattern, which historically has meant warmer than usual winters in Western Europe. And we have entered into what appears to be a pretty strong El Nino. And historically, those are characterized by very, very cold but dry winters in Europe, which would be straining to their efforts to build that robustness into their energy capacities that we just described. However, we have received pushback from that. And look, we're not meteorologists. We're just reading what other meteorologists are saying and judging what sounds right to us. But several of our subscribers have emailed us wondering whether the massive volcano eruption that we saw in the Pacific last year might not have injected an enormous amount of water into the atmosphere, and that might be explaining the warmer than usual weather patterns that we're seeing, and it might foretell a warmer winter in Western Europe than perhaps a traditional El Nino year might deliver. We would certainly hope for that because, again, contrary to what some people on Twitter might assume, we're not sitting around hoping for a crisis so that we can be proven right on anything. We have many friends in Europe and many subscribers in Europe, and we would wish no ill will on anybody, let alone our friends on the European continent. And so let's hope that they get through this winter, because if they do, Andy, then that really next winter and the winter after get substantially easier as all of these investments in LNG import and export facilities around the world start to come online. And so really it is this winter or bust for a true energy crisis in Europe. And let's hope that it's a bust.
Yeah. So if they do have I don't want to assume the negative, but if they do have a rough winter, and it does impact natural gas substantially in terms of pricing, what are the impacts of that pricing on, say, like fertilizers? Because I think there's a substantial amount of fertilizers that get produced over in Europe. Are we going to see another big spike in fertilizers possibly if we get that cold weather that, I don't want to bet on cold weather. I'm just saying if they do get cold weather, we could see fertilizer pricing really move to the upside as well. Correct?
Well, it depends. So there's less fertilizer being produced in Europe today as a consequence of the energy crisis. And the fertilizer being produced in the US today, which is in Canada and other parts of the world, is pretty substantial and is benefiting from extraordinarily cheap natural gas. So maybe this is a good time to sort of explain the intricacies of the natural gas market, because really fertilizer is just a solid embodiment of natural gas. If you think about it, it's shippable and you can export it. In the US, an enormous amount of natural gas is produced in the Permian Basin as a byproduct of oil production. It's called associated gas. They can't get rid of it. We have highlighted that in December of last year, the price of natural gas in California, which has no pipeline capacity to the Permian to take any of that gas, was $55 a million BTU when the price of natural gas in the Permian Basin went negative. They literally were paying people to take it. And that just shows you the vast disparity in regional market price action in the natural gas market. It's the reason why it's called the killer trade, or you just don't want to. Yeah, the widowmaker trade. I mean, you just don't want to get involved in natural gas unless you really know what you're doing. So as it pertains to fertilizer, you would certainly see pressure in the fertilizer markets if we see an energy crisis. But I would argue that we will see far before fertilizer prices absorb any impact, spiking Dutch TTF natural gas contracts and then the Asian contracts reacting accordingly, because really once natural gas gets on the open seas, it's kind of an international market. And for proof of this, the possibility of a strike at the Chevron LNG facility in Australia was driving pressure under European natural gas prices, which shows you that the LNG market is pretty international, whereas pipeline natural gas produced over landlocked areas is subject to its own regional dynamics. Now, we saw the closure of a fertilizer plant in the UK. CF Industries shut down a plant there. I do think that even if we see a spike in European natural gas prices, the likelihood of that translating in a material way to the US is pretty low because we're so oversupplied here. And so all the fertilizer producers in the US would not be subject to those spikes, and in fact would benefit from the ability to, presuming they haven't locked in long-term contract prices, to sell their internationally shippable product at the going rate while paying their input costs at the local prices. And so this is why last year during the crisis, we were telling people that if you were looking for opportunities, anybody that can source natural gas locally but produces something that is priced globally is going to be in a very good position.
No, I agree with that. Totally. So looking at coal, we talked about kind of oil, nat gas. Coal is mainly just the swing producer, right? Is that kind of what we're looking at coal for the most part worldwide? If we get tight in oil and we get tight in natural gas on a worldwide basis, is that kind of the next thing that moves? Is that a fair statement, or how do you view coal?
Yeah, that's certainly part of the explanation of the coal market. Coal, there's a significant benefit to coal, which is it's a solid, it's easy to ship, and you could pile it up, in a giant pile and know that it's there. Natural gas is difficult to store, difficult to ship. Oil is a liquid, it's a bit of a different story. So when you're in the middle of an energy crisis like we were last time we spoke, the price of coal spiking beyond even the price of oil on an energy content basis was surprising, but in hindsight, perhaps not so. Because what was really in hot demand was effectively fossil fuel batteries. I want to buy a bunch of potential energy and store it in my backyard at the country level and know that I have it. And there was a premium to knowing that you have it. And you don't need, sophisticated pressurized tanks to store natural gas, or even large oil storage tanks, which you do ultimately have to construct if you're going to store those things. And you could float them on boats offshore, I suppose. But there's nothing cheaper than just piling up a bunch of coal in literally a pyramid next to your power plant, and knowing that you have 5, 6, 7 months of supply that you don't have to worry about, that is not subject to Putin's whims or the sanctions, or pick your favorite geopolitical risk. And so at the apex of the political crisis, seeing coal be more expensive than oil was really insightful to us. And frankly, if you don't understand why people love coal, we'll never be able to kick our habit of it, to quote our friend Mark Nelson, who's very insightful in the energy markets. And so that's why we watch the price of coal as a leading indicator for the physical tightness in the other energy markets, because if coal is relatively under control, then there's no urgency. I will say, as a last point, at the apex of the energy crisis, thermal coal was selling at a premium to coking coal, which is really absurd. Coking coal is better BTU value, higher grade, less sulfur, pick your favorite metric, predominantly used to make steel. Historically, coking coal had always traded at a premium to thermal coal, but during the apex of the European energy crisis last fall, we saw that flip as well, which really was truly historic and something that we've kept an eye on. But that, of course, has now since reverted back to historical norms.
And switching to uranium, what's your view on uranium? Maybe you can even throw in uranium enrichment. Is there going to be a problem with sourcing uranium, and could that potentially cause an energy crisis in some of these other areas?
No, as it pertains to the crisis. I mean, the cycle times of uranium, flows into and out of nuclear power plants is not on the same horizon as just-in-time delivery of natural gas or, your energy storage capacity of coal and so on. And I think part of that complacency is why we see these periods of relatively low volatility followed by spikes as people all sort of realize at once that maybe they need to buy a bit more. And I recognize that we've gone through a repricing of uranium from something in the 50s to the mid 60s here in the past couple of weeks. And if you look at the chart, it looks pretty vertical, but now it's sort of stabilized in the mid 60 range. I would say that is effectively free uranium, given the value of the material and the relative costs of running a nuclear power plant. That is a rounding error. And so the thing about trading uranium that makes it interesting is the price could double or triple and nobody would really care. At the same time, it could be cut in half and nobody would notice either. And so the introduction of the Sprott Physical Uranium Trust and the tightening of the markets and the need for higher prices to trigger supply is sort of the investment thesis in that space. And I think at these prices, you're starting to pique the interest of some of these producers that have held supply off of line, and prices will, ultimately reach equilibrium. As it pertains to enrichment, I know there's a lot of discussion around the fact that Russia has a commercial monopoly on certain grades of enriched uranium, and that this might be a constraint to the introduction of the latest generation of nuclear technologies and SMRs in particular. In our view, the U.S. military knows full well how to enrich as much uranium as it needs. And this is a very solvable problem on the timeframes that it might present itself. But I do watch with interest. I think $66 or $65 a pound uranium is effectively free for the value of the energy resource that we're talking about here. And there's a lot of headroom for price appreciation before anybody would really become perturbed. At the same time, this is yet another market where the bull case has been well known by a lot of people for a very long time and has taken many, many years to materialize.
Here's another kind of maybe different question. I don't know if you've got background on it, but I know a lot of analysts and people, they focus on the supply and demand of the commodity itself. Looking at history, we've seen eras where we've had an increasing interest rate environment. Money kind of shifts and prefers different assets. It shifts away from the financial assets, bonds and stocks, and go towards commodities during an increasing interest rate environment. With where we're at debt-wise, with the increasing interest rate environment, and maybe you know this or not, but could money just flow into these markets, increasing pricing, irrespective of the supply and demand of the commodity itself? I mean, we seen that in history, like the 2000s? What's your take on that paradigm or view? And maybe I'm wrong.
No, I think there's a lot of wisdom in what you've just articulated. I can only express it through our own prism, by which we approach the markets, which is we earn in fiat and we save by buying real assets like gold and commodities and collectibles, and then we invest privately where we can affect the outcome. We don't speculate in individual stocks predominantly. And so to the extent that inflation expectations are rising because people are seeing the fiscal situations in the G7 countries, in the US in particular, which is just really out of control, it makes perfect sense that money flowing into the commodity sector might increase. But I would argue that more of that money would be sort of savings. I'm going to park my money in gold, silver, uranium, and platinum and not think about it for 10 years. Perhaps far more so than the speculative crowd coming over and trying to make a quick buck on a greater fool's trade. I don't think that the commodity sector is anywhere near the memification of stocks that we see, because like as much as we talk to each other on Twitter and on podcasts, like the vast majority of people don't even think about trying to make a quick buck in uranium, gold perhaps being the one exception, or maybe silver, but the big name commodities perhaps, but by and large, uranium is still a very, very niche investment. The people that own it are very passionate about it, but they tend not to be flippers. They tend to be buy and hold, and I would characterize that as savings money as opposed to investing money. That's certainly how we look at it. And so to the extent that people are worried about finding hedges against potential monetization of U.S. debt and hyperinflationary tail risk, not base case, but tail risk, you could see, because hardly anybody's allocated any money to uranium today, for example. It wouldn't take much in that regard for it to really squeeze prices higher, which I think is probably the base case of some of the big uranium bulls.
Yeah. What about your opinion on, we've got this debt, I don't know, we'll call it maybe a debt crisis. We've got rising interest rates. And then we've got the energy markets that we'll just call it tight. Is there going to be a problem if debt gets out of control here and really starts to accelerate to the upside and the energy markets can't keep up, where you get a vast imbalance between your feedstock for gross domestic product? It's basically the conversion of energy, and your debt. Do you see that there could be a problem here coming up over the next few years?
Yeah, so if you think of fiat currency as money, then your worldview would be that the price of oil might go up. If you think of energy as money, then you would say that the value of the dollar will go down. They're two sides of the same coin, you see. And so I'm a big fan of Luke Gromen's work, for example, and a few other thinkers in this space. If we have truly, if we're truly in the barrel heading over the Niagara Falls of fiscal cliff, then yeah, in dollar terms, in nominal dollar terms, the price of oil could reach levels that would surprise people, which is why, of course, there is this push or perceived push amongst the BRICS countries and OPEC nations to diversify out of U.S. treasuries as the reserve asset, which is different than, of course, the reserve currency being the U.S. dollar, and towards a more neutral reserve asset like gold or some basket of commodities. Because ultimately, people that are long oil and selling it today, the producers, the exporters, and the people who are short oil and importing it today, the Chinas of the world, both have the same objective, which is we would like our oil to be, the purchasing power of the oil we will sell someday to be preserved, and the purchasing power of our excess reserves to be able to procure oil to be preserved. And to the extent that the U.S. falls over the fiscal cliff and U.S. treasuries no longer serve that intermediating role, things could change. That's a lot of if and a lot of to the extent that as we go through that now. So the base case is we won't deviate too much from historical norms as we sort of cycle between fiscal stimuli and fiscal austerity. Having said that, the outlook for fiscal austerity has never been dimmer. In our view, we run trillion-dollar deficits without even thinking about it anymore. I'm old enough to remember when billions of dollars would make headlines, and now we don't even blink at trillions, let alone the corruption and waste mismanagement and diminished return on investment for those fiscal stimuli. So it is a fascinating time. The Neil Howe fourth turning type model seems to be playing out pretty well, which is a scary thought.
Yeah. Do you think that the central banks or governments, in terms of the situation that we're in, do you think they understand the situation that we're in? And do you think they have any sort of control over it? Do you think this can get out of control where the debts start to skyrocket and our energy system or our GDP can't keep up with it? So we're just going to get kind of runaway inflation?
Well, this is the debt spiral case that people are worried about. And I would say there are two answers to that question, and they might not necessarily flow from one to the other. I don't believe that the Fed and their army of PhDs, and nothing wrong with PhDs, by the way, I have one, don't have a good handle on how the economy is actually working. And that's just laid bare by their inability to predict things. I mean, they missed the inflationary pulse and certainly the magnitude of it that has arisen as a consequence of the fiscal stimulus, as a consequence of the reaction to the COVID-19 pandemic. But at the same time, that doesn't necessarily mean that we're going to have a full-blown crisis. That they're flying blind doesn't necessarily mean we're going to crash into a mountain. And so there is still a lot going for the U.S. The U.S. dollar, the amazing assets the U.S. has. We are an energy superpower. We're surrounded by peaceful neighbors with abundant resources. We have abundant resources of our own, a lot of geopolitical advantages, an enormous amount of wealth, highly liquid markets, and so on and so on and so on. And so there's There's probably somewhere in the middle where they don't know what they're doing and they'll lock into a better outcome than we fear. Because if you look at the trends and then apply a basis of ignorance amongst leadership to that trend, then it's easy to fear the outcome. And Doomberg, the name notwithstanding, we're probably sort of short-term pessimistic, long-term optimistic if you pushed us.
Do you think there's another wave of inflation coming ahead of us?
Keep a close eye on the price of diesel. If you had to pick one commodity, that would be your leading indicator is the wrong word, a tracking indicator of the current inflationary pressures. It would be the price of diesel, because diesel is involved in the transportation of virtually every good that matters in the economy, including consumer goods to mine goods, to pick your favorite. And so one risk to this sort of inflationary story is this refining capacity and our ability to match what refineries need. And this, of course, is vastly overlooked and ignored by the sort of global warming environmentalist crowd as they pursue their green energy agenda, which is also in of itself not hyperinflationary, but certainly adding to the inflationary pressures of the market. And then something we wrote about that we stole from a guest on Grant Williams' podcast, that his name escapes me now, but don't underestimate the inflationary pressures of the total amount of waste and made up jobs that we are saddling our corporations with. If productivity is a measure of GDP per capita, we have more people in made up jobs than we've ever had. Compliance and ESG and pick your favorite, and it really is something that we hadn't really pondered until we listened to that podcast, to be honest with you. In fact, I pulled his name up as we were talking just to give him full credit. Christopher Joy, who's the chief investment officer of Coolabah Capital, made a really insightful point, and I want to quote him. He said, just consider the big banks who have seen a massive increase in, quote, compliance departments, risk departments, legal departments, government affairs departments, ESG departments, and human resources departments, which leads to the inevitable result that we were, quote, producing similar products with many, many more people. And we went on to say in that piece, the plague of meetings as well. Once you have people in made up jobs, they feel the need to fill their calendars so that they feel important. The GDP per person is not responding to the technical revolution that we have been able to create, in large part because we have a bunch of people in made up jobs, and these big corporations are becoming sluggish, and that's adding an inflationary pulse as well.
What about a lot of people are scared of a slowdown, a recession. We've got an inverted yield curve. What's your thoughts around potential slowdown that's coming maybe in economies? And what's your thoughts around that?
So we come from industry, and we have a pretty robust Rolodex of contacts who work in heavy industry, commodities, the front end of the economy. They're seeing massive slowdown. It's not reflected in the government data, but let's just say the pucker factor is high amongst our friends at the front end of the economy. Order rates plummeting, accounts receivable payments coming in late, dubious collectibles, all the signs that you would see. I think the strike amongst the auto workers is a bit underreported risk to the economy as well. That's an enormous cog in the machine of the North American economy that is beginning to have some wrenches thrown into it. So I would say that in the front end, the chemicals in particular, which is a sort of the ultimate leading indicator, our friends in the chemical industry are signaling not red, but maybe orange, with a negative outlook, and we shall see. It does have a certain wait feel before the crisis for those of us that have been around long enough to remember that maybe subprime is contained. I don't want to say that the pin has been pulled on the grenade and we're all waiting for it to explode, but it does have that feeling. And if you pushed us, we would be cautious in our 3 to 9 month outlook.
So if someone was kind of looking at this or listening to this podcast here, would you be more conservative? I mean, knowing that information that things are kind of, quote, orange, or how does one protect oneself in this type of environment? Is it something where you need to start looking at some particular indicators or something like that?
Yeah, it's difficult for us to give sort of broad stroke advice, and we're not in the investment advice business either, of course. But broadly speaking, if you have a financial advisor, you could perhaps have a discussion where you say, in the event of a deeper recession than people are pondering, what's the impact on the portfolio? And look, it's only one Fed decision to revert and to go into QE infinity and stop quantitative tightening and to cut interest rates again, where you could see stocks fly. And so the classic challenge of timing the market based on these types of analysis exists today and is just as difficult as it has ever been. And so I would hesitate to say, we have our own way of managing our portfolio, which I articulated earlier, which we're comfortable with. And that is sort of immune or insulated from the daily moves in the popular stock markets by design, because we're just not good at it. And so much better at investing privately when we know the management team, and we can perhaps participate in creating some sweat alpha, as I like to call it, or the gold that I own in my safe, or the collectibles that I've purchased, or the land that I've purchased as hedges against inflation. I don't really care what the marks are on those assets on a monthly or even a yearly basis. I measure my net worth in acres or in ounces, not in US dollars, and that's by design. And as soon as you start looking at the mark in US dollars, then you're treating that as an investment and not a savings vehicle.
Okay. Do you have anything else that you'd like to share? Anything that you're working on, or anything that's coming up that you'd like to share?
Yeah, no, we're just having fun, doing our thing, studying the energy markets. We've got a fascinating piece coming out. There's a lot of there's no shortage of insane policy proposals as we try to solve the carbon challenge. And we have a piece coming up that's an edit today on whether we can actually make jet fuel from CO2. There's all these e-fuels and renewable carbon fuels, and sustainable aviation fuels is the moniker that they've decided to put on it. And we have a lot of fun tearing apart these proposals and showing the reality of industry. And so no, we're just, doing our thing, having fun, publishing 6 to 8 times a month over at doomberg.substack.com, and doing what we were meant to do, and having a blast doing it, and then having the opportunity to talk to the great guys like you on the side as we do our podcast appearances. So really appreciate the opportunity to be here today.
Well, that's all I've got. So
Awesome.
If people wanted to reach out to you and follow you, obviously you've got Doomberg Substack, but any way else that they could follow you?
That's the main way. We've de-emphasized our Twitter account and spending all of our time in the Substack ecosystem. They've launched Notes, which is an interesting sort of alternative to Twitter. I wouldn't say competitor. It's a different platform, but similar features. A bit friendlier, at least in the early days, and fewer trolls, and more people interested in reading good things and interacting in an intelligent way, which is something that we're very attracted by. And so we're spending all of our time on Notes, writing our pieces on Substack, and then doing the occasional podcast appearance like this. So really appreciate it.
Okay. Well, thank you for coming on, and see you, everyone.